Welcome back to the investor workshop. It's been another positive week, judging from how stocks have gone up in value. And what I thought this week we could do is kind of dissect one particular industry, which is technology, and seeing which companies within technology are most desirable. Not to say that they're a good investment at this time, because stocks are pretty expensive, but maybe, if anything, how I think about when I look at an income statement and comparing income statements of three companies that participate in technology. And the three companies I'm going to look at are Adobe, Dell, and Broadcom. And what I thought would be interesting to show is how each company has had a different history over time, and how we can use that as kind of a concept of how can I find the next, very desirable company? How could I then appreciate maybe the best performing companies from a stock appreciation perspective, and know when to buy a particular company because they're just really inherently desirable. So let's take a look first, kind of high level, how these stocks have traded over the past couple of years. And I'll do that by looking at Google Finance. I like how they chart their information. So we'll go with Adobe, Broadcom, and then Dell. So we see that over the last year, it looks like Dell has been doing quite well. Adobe has lagged the others, and Broadcom has been doing quite well. If you look at the 5-year, I think both Dell and Broadcom have really performed well. A couple of years back, they were all kind of tracking each other. I know Broadcom specifically, I invested in Broadcom. I owned Broadcom for multiple years, and then I sold in around this era, 2023. And I did not participate in the remaining rally of Broadcom. Dell, I've stayed away from, and I'll get to that later. So these companies have been doing well. Adobe's done 80% over the last 5 years. But let's take a closer look at it and see what it looks like. These companies just crushed it, really appreciated highly. All right, so let's start with, I'm going to start with Broadcom. And Broadcom is a semiconductor company, and it's a fabless semiconductor company. What that means is they don't own a foundry. You've heard about Intel owning their own foundries. Taiwan Semiconductor, that's a pure play foundry. They own the factory of creating semiconductors. What Broadcom decided to do was, hey, the foundry, it takes so much capital, it takes so much operating activity and investment and so forth. We'd rather own the design of the chipsets and really focus on the designing and in the engineering, and leave the foundry business to a partner. In this case, it's TSM. Go ahead, Scott.
Yeah, just a quick comment. So when people talk about fabless versus fab semiconductor companies, this is what they're referring to. And most are, for that very reason, fabless.
Yeah. I think most new semiconductor companies out of the gate, they're like, hey, fabless is the way to go, because you can go from startup to making money much faster. And Broadcom is now worth $838 billion. They started well after Intel. They started well after AMD, and they have surpassed both of those companies in market cap. NVIDIA is fabless. And the good news is they get to be more profitable because they control the intellectual property, the IP, the patent on that technology that then many other companies will use in their products or their services. So that is Broadcom from a high-level business perspective. Their PE is really high, 151. Incredible. That is a really high PE. Forward PE is going to be 30. And what I'll do is take a look at their income statement, kind of show a few things. It's a strong buy according to analysts. Now, one of the things that is kind of mixed into this number is that Broadcom acquired a software company, VMware. And VMware is a software that enables companies to take a server and then virtualize that server and create, let's say, 10 smaller servers within that one hardware device. And that enables them to have more capacity, more flexibility, and overall reduce cost. So it's a very good solution, but it's a software solution. It's not a semiconductor solution. Now, from my point of view, this is not organic growth. It's not as good as NVIDIA growing 100% organically. That means they sold the same product they had a year ago, just twice as much, or they have twice as many customers. That's the best growth you can have. Acquisitive growth that is gained by acquiring another company could be very good, but it's not as good as organic growth, in my opinion. And that's what's blended into this number. So I think if you look at this number just kind of naked eye, you could be maybe looking at it, you didn't look at it closely enough because they acquired a business. All right, so they acquired this business. Let's take a look at their margins. So they jumped up here. This is where VMware got acquired. And VMware, I think, was a good idea, by the way. VMware is good. In my opinion, Broadcom bought VMware because the semiconductor industry could be cyclical. It has really nice growth for a while, and then they have a drop in revenue. And software tends to be good, continuous growth. So it's more stable. VMware, they're trying to move all customers to a more of a subscription model, which would give them very consistent revenue. All right, so those things look good. Now let's take a look at margins. So there's going to be a couple of things I'll look at. So revenue growth, again, they grew nicely, but I really like seeing these numbers instead, which is before they acquired VMware, and you can see the cyclicality: high growth, slower growth, higher growth, slower growth, and then they had the acquisition. Now, when we look at gross margins, excellent gross margins. Okay, they're 70%, 74%, very good. It means they just taking the product. Now, what is gross margin? Simply stated, if we just measure the direct materials, the direct overhead cost, keeping the lights on in the factory, that kind of direct cost, and the direct labor, the people that actually worked on creating the product and making a finished product, that's gross margin. We have other expenses to keep the company operating: HR expenses, sales and marketing, and things of that type. But those come later. Those get us to a net income. But right now, gross margin, having gross margins at 74%, very desirable business. That's why they're worth more than $800 billion. So that looks great. Free cash flow has grown very nicely from 8 billion, 9 billion, up to 18.6 billion. Very good. Okay. Now their debt did increase. I'm not going to get into debt a whole lot. But just be aware that when they acquired VMware, they did attain more debt. So there's more debt on their balance sheet now. That's how they acquired VMware. So we have a company with margins at 74%, free cash flow at $18.655 billion of free cash flow. And their market cap is 800. And I have a full valuation on Broadcom, so I don't have to note too many things. I just want to make sure I noted a few things. There is a question or a comment. Go for it.
Yeah, I'm sorry to ask such a basic question, but from a non-accounting background person, what exactly is gross margin? Is that just profits before you take any of the taxes or operating expenses into account?
Yeah, let me answer that question. So let me use okay. So in Broadcom, right, a semiconductor they produce, there's material, silicon, there's copper, there's all these materials, right? And there's labor, the people that had to help manufacture that semiconductor. There's direct costs, which would be the power that was consumed, the direct overhead, which might be an ASML machine. But see, Broadcom, they're fabless, so they don't have to touch the factory. So for them, it would basically be TSMC charged us they're at 74% margin. So TSMC charged us $26 and we sold it for $100. Therefore, we have 74% margins. Okay. Now, okay, but there's more cost or elements of expenses that go to running Broadcom. So we have gross margin. Now, people had to go out in the street and sell the next generation of chips to their customers, sell VMware to customers, manage those relationships. We had to have people manage the contracts, manage everything there is kind of in the back office of a company. And these are selling and administrative costs. These are after gross margin. Okay. So the gross margin is just directly to making the product that you sold. Okay. But then you have to run the company. You have research and development. So now you're creating the next generation or maybe the next version of a particular chipset, or you're developing the next version of VMware. And that's research and development. That's not included in your gross margin. Then operating expenses. You have HR systems, you have benefits, you have real estate related to the general offices of Broadcom. So everything else gets put into this operating expense bucket. So then when you take the gross margin and then you subtract some of these areas of expense that are related to running the business and doing research and development, then you get to operating income, which is a lower number after we deduct those expenses. Okay. And then after that, you have interest expense. Okay. Interest expense shows how much balance sheet debt you have. And remember, I said they acquired VMware, so they more than doubled their interest expense. Now they caught a lucky break. Interest rates are dropping, so they could probably renegotiate or reissue their debt at a lower rate. And then we come down. Now we're getting into like these little detailed items that usually they shouldn't have a meaningful impact on the net income. But here's that VMware acquisition, merger, and restructuring charges. So they probably said, hey, VMware, we acquired you. We don't need two of everything. We don't need two CEOs. We're going to have the CEO of Broadcom run the whole thing. So maybe the CEO was let go, unless that person was given a job. I don't know. But you're not going to have two of everything, right? You're not going to have two earnings calls. No, VMware is now a part of Broadcom. So you have some restructuring charges there, one-time effect. Legal settlements, one-time effect. It's not part of operating. So now you have pre-tax income, you have taxes, and then you have your net income. Okay. Did that answer your question, Scott?
Yeah, I got it. Thanks.
Yeah. And this industry by industry, income statements will vary, but usually industries that are similar will have the same kind of format. But if you looked at an income statement for a bank, it'd look very different. They have very different metrics that they want to share with investors. And so just keep that in mind, that what we're seeing is maybe about 60 to 70% of income statements are going to look like this. But just be aware, some industries will have income statements like our REITs, real estate investment trusts, will have an income statement that's different. And you have to kind of know which industry you're operating in, so you know the type of income statement you should be seeing with the particular revenue and expense buckets that you would have. So, all right, so we're in Broadcom. I like their margin. I like their free cash flow. That's why I invested in them for a while. I made money on them, and they just got really expensive. But let's just kind of put that off to the side. When we look at Broadcom, and you've seen this quadrant here, I like Broadcom. I think in a lot of markets, they are very unique. Broadcom, I put them here because they do have some competition, but in communications, Broadcom's really, really strong. Their technology is in a lot of the smartphones that we use, and that's where they built the company. They have really, really good technology there. So I like them. I think they have a nice wide moat. Their technology is in place. VMware is the leader in that space of virtualized data centers. So I like the company. Not a perfect, hey, they're way up here like NVIDIA, because NVIDIA truly is very, very unique and they have a super strong moat. All right, so that's a quick flyby on Broadcom. Now let's take a look at Dell. Now, the semiconductors that companies produce end up in a server or a smartphone, but we're going to talk about Dell as a hardware company. And what's really driven the stock price for Dell there's a couple of things. First, Dell had some pretty tough years. And I think coming off of those lows, I think their stock prices really picked up. Their stock price was going from $34 a share up to about 123. So they've really done well for investors. Congratulations to Dell stockholders. So they're an $86 billion market cap company. Dell has been around longer than Broadcom. And the Broadcom I'm talking about, Broadcom has been an acquisitive company, but I'm in Southern California. One of the big success stories in Orange County, California is Broadcom. Broadcom was founded by two really intelligent guys. One of them was a UCLA professor that left being a professor because he founded Broadcom, Samuel Lee, and then I forgot his founding partner. And they built Broadcom. They did it kind of a garage, started in a garage kind of story, and then they became Broadcom, and they came out with really good ideas. And then they merged with AVGO, and then they now acquired VMware. But the name Broadcom came after Dell. Dell was part of the first PC revolution. And the reason I want to say that is Dell was founded first, but now Broadcom's worth 10 times more from a market cap perspective. All right. And the reason it's the PE for Dell is 21. This is a hardware company. It's in technology, but it's a hardware company. And hardware companies, I've learned, are not as valuable as software companies or semiconductor companies, just because you'll see different margins when we get there. And their forward PE looks pretty good, 13. Now, Dell is riding the AI story, which is, hey, we're going to need a lot more Dell gear to power up AI. So let's take a look at their financials. So that AI story is pretty big, but their revenue growth is quite unimpressive, in my opinion. And last year, you look at last fiscal year, they actually dropped revenue. So what's going on? Now, Dell does sell PCs, they sell servers, they sell into the data center, which is the biggest, strongest computers. So, I would like to see, that's one of the things within the AI story, the AI hype. NVIDIA, most definitely, we can see that, okay, there's real revenue there. That's really booming. But when you see companies like Dell, it's like, wait, where's the boom? There is no boom in this growth. All right, so that's one thing. Cost of revenue. Again, how much does it cost just to get the product that they sold, just to get the direct materials, direct labor, and direct overhead? You can see the gross profit is very different. In fact, when we look at a percentage perspective, the gross margin is only 22%. Okay, that's why Dell is only worth a 1/10 of what Broadcom is worth. Broadcom chips may end up in a Dell server, but those are two very different businesses, and you can see it in the gross margin. Why is the gross margin so much lower? Well, in this number up here, cost of revenue, they have to pay NVIDIA for a GPU, and that's a really expensive component. They have to pay Intel for chips. They have to pay Broadcom for chips. They have to tangibly create a product, make it out of metals, quality aluminums, quality copper. They have to put a lot of cost into the actual product. And this is not including the design, because that's in R&D and so forth. So the margin is quite lower. The free cash flow is substantially lower, 2.8 billion. Now their top line revenue is 93 billion. Our friends at Broadcom, they're half the size, but these guys produce $18 billion of free cash flow. These guys are twice as big, and they only produce $2.8 billion of cash flow. So Broadcom produces 9 times the cash flow, maybe 7 times the cash flow. And they're half the size when you look at revenue. So that's a big difference, right? And you look at this cash flow consistency, not consistent, up and down, up and down. They had some pretty good years, but they've also had a really tough year in 2023 when the revenue came down. So margins are very different with Dell, and the free cash flow is very different, quite a bit lower. So when I look at Dell, it's not a desirable company for me. I actually put them partially in the red. Why? Dell has to compete with Chinese competitors that have a very attractive cost model. Dell already manufactures most of this stuff in China. They have to compete against everybody who's in hardware. And that's just a lot of competition. They can grow, but their margins aren't very good. I think that a lot of the technology space is moving to a service. Everything's a service now. You go on the cloud and you're getting a lot of the technology that Dell and other hardware companies are producing in the form of a service. It's kind of like, to use a simple but I hope effective analogy, is when I pick up a phone and make a phone call, I don't have to pay for the cell phone towers. I don't have to pay for all that stuff. I'm paying for a service. And the infrastructure makers are Dell and their competitors. They're kind of getting over commoditized and constantly being put under pressure. Scott, you've got a question or a point?
Yeah, I have a follow-up question about margins. And so would it be a fair statement to say that the difference between, well, I guess a better way to phrase it would be that the operating expenses would be more or less similar across an industry, and it would be a way to compare industries. So for example, generally speaking, software companies are going to have lower operating expenses and thus higher final margins, or operating margin, I guess you could say, than utility companies and railroad companies. Does that make sense? Am I on the right track here?
Well, let me process what you shared and see if I'm on the right track in responding to you, which is, like, we're comparing Broadcom to Dell. Would there be a big difference in operating expense? And the answer is yes. Let me show you a couple of differences in how their operating expenses would be. Now, you would, like, if you compare Dell, so let's say HPE, and maybe you compared, and it's tough to compare against IBM because IBM's a more of a collage of different companies, but Innovo. So let's say you compare pure play hardware companies. You could look at operating expenses and see who's really operating effectively and who's just wasting money. Okay. But let me show you, like, research and development. It's very different because Dell is not doing a lot of R&D. A lot of the R&D is handled upstream by the semiconductor companies, maybe even somebody who's making like better displays that are more energy efficient and better on the eyes and so forth. So the R&D is upstream. So they don't have to spend as much on R&D, but they still have selling it in administrative expenses. Maybe let's see how much that is. Yeah, I see selling and administrative expenses are actually pretty high. And then operating expenses, I think, are going to be lower. So yeah, there is lower operating expenses on the Dell side, but you're starting with a really lower gross profit number. All right. So following on Dell, you can see that Dell just has lower gross margins, and it becomes, just a tighter amount of revenue to, or gross profit to work with. Now you have to sell the product. You have to keep making your product better in research and development. You have to keep your back office operating, HR systems, attorneys, all that good stuff, managing contracts, managing the, general offices that they have, real estate expense, and all that good stuff. Then they have some interest expense, and we get down to net income eventually. So you can see where I form a conclusion that semiconductor companies are far more valuable than hardware companies, and you see the reasons for it. That's my conclusion, and I'm open to any feedback that you guys have. I know the valuations are very different. This one is worth 1/10 of the value of this one overall as a market cap. Okay, so now we had a semiconductor company make semiconductors that go into servers and infrastructure products that are going to power up software. So now let's talk about a software company. So Adobe is a very respected software company. Their specialization and their moat and leadership is in the creative aspects of software. So creating documents, images, videos, editing, all kinds of stuff. Adobe is just excellent. It is a huge success story in the San Jose area, if I'm not mistaken. And they have just been a really, really good company. They have a substantial market cap, but lower than Broadcom. $243 billion, revenue of $20 billion. How big was Broadcom? Broadcom's over 2 times bigger. And their PE is 46.8 in the current year, next year, 27.8. They're a buy according to analysts, and they're discounted by 8%. As we look at, so we know Adobe is a software company. Let's look at their financials. All right, so we have call it 21 billion in revenue. Gross profit's pretty high. Let's see what the margin is. Gross margin, 88%. Isn't that a beautiful number? 100% would be better, but I think that's impossible. 88.66%. Holy smokes, that is some margin. Free cash flow, 6.5 billion. Not as high as Broadcom. Broadcom was 18 billion. Broadcom was more than twice as big from a revenue perspective. If you, let's say, rationalize this and maybe multiply this by 2.5, you get up to maybe 15-ish to kind of compare against Broadcom. But this margin is a little bit higher than Broadcom. And the reason for it is in the software space, when you write software, right, Adobe Acrobat, they write it once and they keep improving it, right? They might have enhancements to it, but the primary intellectual property that you're selling, you can sell it to 1 billion people and you don't have to rewrite it every single time. It's not like Broadcom has to make an additional unit of chips and then sell it to the customer. They have to make something, or Dell has to assemble a server and then ship it out to the customer. No, Adobe's like, oh, you want to buy this? Great, $100. And you can download it here. So the cost of delivering that product, in this case, it would be a subscription, most likely, is very, very low. And that's why software companies have been historically very valuable. Microsoft's the same model. And Bill Gates became the wealthiest guy and is still one of the wealthiest guys on earth because he tapped into this model of high profit. So Adobe is a leadership position in the creative software space. They have beautiful margins, great free cash flows. So as I look at Adobe, I put them in the most desirable space. The other thing I like about Adobe versus Broadcom is when we look at their seasonality, or you look at their cyclicality, like semiconductor can be cyclical, and it makes sense. Let's say there's a run up on PC sales, right? And everybody buys a PC. So the semiconductor company benefits. Okay, great. My revenue went up by 25%. But once people have PCs, they're not replacing them every year. Heck, some of my PCs I use for like 10 years and then I replace it. Unless there's a revolutionary reason why, oh, I need to have the new PC because it does X. I don't think there's many events like that. So you have a run up and then you have a decline because everybody has the products they need. But in the case of software companies, they charge a subscription. If you stop paying the subscription, you stop having access to the software. So you're seeing a natural slowdown in the Adobe business, but that's because this number keeps getting bigger. Look at that beautiful upward growth from 7.3 to 21 billion. That is a sign of a strong business. It keeps going up. They're still growing at 11%. So they're going to announce on the 11th. That's around the corner. We'll see how they announce. Somebody else that was in their ecosystem, DocuSign, their stock went up over 27% yesterday. I'm a DocuSign stockholder. Thank you, universe, for that nice gain. They're a software company, and their margins are not quite as good as Adobe, but they're right up there in the 80s, like mid 80%. Okay, so we have Adobe here, Broadcom here, Dell here. Now, the valuations I have on these 3 companies, let's start with Broadcom. So I think Broadcom's overpriced by 52%. It's a great business. It's a great company. I owned the stock for a time, but the stock price just shot up. And again, the market's teaching me a lesson temporarily, right? I forgot who said it, but in the near term, the stock market's a voting machine. In the long term, it's a weighing machine. You have to weigh the value of the company. And I have weighed the value of Broadcom for years. I bought when buying was good, and I sold when I thought the selling was good. So far, the market, the popularity contest has the price way higher, and I think it's overpriced. both looking at free cash flows as well as earnings per share.
I think that was either Buffett or Charlie Munger with the weighing quote, but not the most important point. But
yeah, you nailed it. Which is, so NVIDIA is incredible, man. It's incredible how valuable they've gotten, and good for them. Good for them. All right, so Broadcom. That's how I see that.
Just
company.
let me correct. This statement is of Ben Graham, their teacher.
I think you're right. I think, and they.
No, I just
Warren Buffett and Charlie Munger are disciples of Benjamin Graham.
Yeah.
So it's kind of like they're passing on the message that Benjamin Graham.
Yes, I stand corrected. And Ben Graham's book was basically the seminal work of value investing, right?
Yeah. Yep. So that's Broadcom. Now let's take a look at Dell. Oh, it looks like I'm not valuing Dell. I think Dell is also highly overpriced. And I think there's a lot of excitement around AI, and we'll see how far it goes. We'll see how far artificial intelligence goes, but you can see the run up is really taken hold. But again, when you see this kind of run up and you look at their growth, there's something there that is like, okay, that doesn't line up. Why isn't their growth growing like at 25% or, some really impressive number? But you can see that their gross profit isn't very high. Their free cash flow isn't very high. So that's why I don't even track Dell. It's not a company I want to touch. And then let's look at Adobe. So Adobe is fairly priced. Now, I'm going to try to quote Warren Buffett accurately. I'd rather pay a fair price for a great company than to get a great price on a fair company. And I'm buying into Adobe. I think Adobe is being left off to the side with the AI kind of storylines. Right now, the stock price is fairly priced, but I continue to buy shares. I think it's a company that I want to have. The biggest software position I have is with Oracle. I'm employed by Oracle. I'm not going to say much about Oracle because I don't want my employer to get mad at me. I think Oracle's great, but that's as far as I'm going to go. And Adobe, I have great respect for. They are such a good company. I love their fundamentals. I like their business, and I'd rather pay a fair price for a great company. So what I hoped to accomplish in kind of going through this kind of thread is, giving you my perspective of, looking at companies that participate in an ecosystem, right? These guys make the semiconductors, they go into a server, and then software companies use that server, and seeing that companies are valued differently. There's a greater appreciation for the fundamentals. This has great fundamentals. I think the best fundamentals of the pack. This has great fundamentals. Stock price is too high. And this has the worst fundamentals, and the stock price is too high. So anyway, I thought that might be interesting.